Hello guys, welcome back to another video here at Financial Hub. So if you watched the previous video, I talked about putting a couple of things into perspective, certain candlesticks, certain patterns, and a few stuff. So if you haven't watched the previous video, I've talked about that. Make sure to watch it first before you proceed to this video, because this is a continuation of that one. So welcome back for those who are here. And if you remember well, I talked about the different candlesticks, especially the three push pattern, the Marubozu candlestick, and how to put it into perspective, not taking everything you see at face value. So now what do we do next? Now, entry session. I talked about this a lot, the market sessions. When I said I used to ignore market sessions a lot of times, because when I've gone improving in my strategy now, this is something that we did not have the advantage of when we were starting out, and this is the advantage most of you have, especially if you find a good mentor, if you find a good teacher, if you find an experienced trader who is showing you what they do, not just saying what you should do, okay? And someone who's also gone through the experience. So for me, I used to trade, I've come a long way. I used to trade a certain pattern, many patterns actually. I came toning it down to trade one specific pattern. Then that specific pattern, my students used to ask me in class, and this is one advantage of also teaching, is because you help improve your knowledge and understanding on some topics. And my students used to ask me, okay, Caleb, you taught us about market sessions in the first few classes, and the market sessions include which session? We have the Tokyo session, the Sydney session, New York session, and the London session. Those are the main market sessions when we're looking at the financial markets. Okay, now today I'll talk about which one is important, which one is not, and what for me. Okay, so my student asked me, what sessions do you enter the markets, or what time do you look for an entry and all that? Now to me, back then I used to enter anytime. If I see the market trading at midnight, I'll enter. Maybe it's reached the entry level I'm looking for. If it's at 3 a.m., 4 a.m., anytime I wake up, I see an potential entry, I trade. If it's during London session, New York, Asia, any session, I'm just trading. I never used to have a specific time. Mind you, even 1 a.m. I'll take a session. Now, this was not a right approach, because my approach to entry was random, and the market's nature is random. So if you mix two random things, what do you create? Chaos. Chaos, okay? It's just chaos. It's pure chaos. Markets are random, Caleb is random, let's be random. Everyone is chaos, okay? Now, the fact that the nature of the market is random, it is up to us to come up with a system that is systematic. So you approach a random thing with a system, sort of giving it some balance at the end of the day. Because at the end of the day, as much as you have a systematic approach, doesn't mean now everything will work according to plan. At the end of the day, we can never predict what will actually happen. Some things are bit random at the end of the day. So what we tend to do at the end of the day is come up with a system that incorporates also your timing. Be consistent with certain time sessions, and that's what I'll talk about. How not to be random with your timing, which will help improve your strategy. These days, trust me, if I find a trade entry at 1 a.m., you know, sometimes maybe you have those sleepless nights, and you're trading you're watching the markets, and you just tend to open the market to see a shooting star at a certain level, and you say this is a very good short position, and it was at midnight. These days I don't have those ones. I never enter at any specific time. These days I specifically enter during London and New York session. Okay, I always look for my entries during London session, okay, and New York session, okay, because of various reasons. Okay, I didn't just come to that conclusion. Okay, first things first, I went through all my trading history, look at the losers and the winners, and some correlation in terms of timing. Now, leave alone strategy and all that, timing. I noticed that a big percentage of the trades that I took during those weird sessions ended up coming out as a loser. Why? Because maybe I got that entry too early, maybe I didn't wait for a proper candlestick to form, and then when the next session comes, they end up just spiking me. I'm very right on direction, but I'm wrong on timing. In trading, in technical analysis, and I'll write it down, in technical, and I've talked about this multiple times, you want to be right in the direction, and you want to be right in the timing, okay? For example, this market was moving to the upside. If you came and bought at this level, you're very right on the direction, okay? It's good. Someone will say that's valid and the markets are moving up. Yeah, it's good to have entered at that point, but you're very wrong on timing. If you're right on direction, wrong on timing, trust you, my friend, you're going to lose money, okay? So you want to find a way, how can I know the direction? How can I find the timing? Okay, now those are now deeper things that you can go and look at and we teach in our strategies. But for today, I'm talking about timing and the time sessions. So one way to get good timing is to look at the sessions, okay? Now, after analyzing all those pairs, all my trades and finding out, okay, I tend to lose money when I have wrong entries. And the ones that I have very good success rate are the ones that have very good entries during either London or New York session. London, New York session, okay? That was step number one. Took it a step further. What are the pairs I'm trading? And that's the same thing you want to look at. All my pairs that I trade, and these are the pairs that I trade from USD CAD, Aussie dollar, gold, Euro USD, GBP USD. Then I trade three indices, the US 30, which is the Dow Jones, US 100, which is the Nasdaq 100, and the US 500, which is the S&P 500, okay? All those have one thing in correlation, the US dollar. All of them, they have one thing in correlation, the US dollar. Now, the US dollar, of course, we'll see most movement happening during the New York session. Sometimes pre that, we normally see also during London session. Why does London session heavily affect the dollar pairs? Because euro is directly correlated to the dollar. If you look at the dollar index, it is 57% of it is derived from the euro. So go do more research on that for the people who do not know much about the dollar index. Looking at the relative strength of the dollar, it is connected to the euro, okay? Now, when you're talking about euro, you're talking about the Europe area, okay? What governs that area? London. London stock market is the one that's sort of central. It's the most, it's the financial center of the world. Okay, it's where we experience most volume in the markets. Now, don't get me wrong, not most volatility. Most volatility is seen during London, New York, okay? I'll talk about this, I'll talk about it in a few. But the most volume is normally coming, the heavyweights, what work on a pesa, coming heavily during the London session. Volatility comes a lot during the New York session because of a lot of news releases and such stuff. Another reason that I was saying I'll talk to you about is when New York is about to begin, it's the same time London is ending. So there's an overlap between 4:30 when New York begins and 6 p.m. Okay, Kenyan time. That's Kenyan time or Nairobi time. 4:30, around 3:30 to 6. Okay, depending on the time of the year. We have to look at the time of the year. Certain times of the year, 4:30 to 6. Sometimes of the year, during 5:30 to 7. So it depends. We'll talk about this later on when the market shifts in terms of timing. But those are the times that the London and New York are both still active at the same time, just before London session closes. Okay, so during that time is when market are most volatile because you've gotten these two big heavyweights with the different narratives coming into the market. So maybe even same narrative at the same time. So the session is very important. So for me, I used to lose a lot of money, especially during that overlap. I used to enter midnight or 5 a.m. in the morning just for me to be spiked out during London, New York, or that overlap for markets to start moving in the direction that I was looking for. So if you're right on direction, wrong on timing, trust you, you'll be wrong on that one. So I came and looked at my pairs. So all my pairs have something in correlation that the dollar, which is affected heavily during London or also during New York or during that stuff, the overlap. Now, then I took it a step further. I went and did now backtest. Okay, so you can see if you watch the previous video, I talk about the scientific method, and I talked about how observing. Let me try and remember often. So you observe and question, then you sort of research on that topic, Same thing I did. Then you go come up with a hypothesis. Now that's what I came up with. I went and looked at my data and all that. So I sort of had a bit of data, but I took it a step further, went and back tested. So I looked at multiple flags on all these pairs I trade. I have that data, which I'll share with my students. So if you're a student here, and if you've joined our new program that's coming up, which we'll talk to the public about very soon, I will share all that there, the nitty gritty. Okay, not to the public, but to the private sector. I'll share with you that data where I looked at each, and trust you me, each and every of those trades that I trade, all of them on all these pairs this year, looking at the entry, they had one thing in common. They started between London and New York. London, New York, London, New York. So that was another step I took it. So back testing. Then I went into the data of looking at backtest. Now all my backtest, I always look for market has to be a certain entry, and those are when I get very good trade setups. Now, trust you me, this has also led me to missing out on many other trades, and that's why maybe these days you'll find me saying, Caleb, I trade less. I've not had a trade in the past 2 weeks, because I'm very rigorous, very strict with my approach, with how I approach the markets. I'd rather wait 2 weeks. Hell, even a month. I'd rather wait that long before I get a trade entry, because I'm looking for my criteria to be met. I found out that the more patient you are, the more quality trades you're going to get, and the more success you're going to get at the end. Okay? So timing, very important. Okay? So for those who do not know, London session, Kenyan time. So let's break this down as I finish, because here I just wanted to talk about timing. Timing. Do your own research. Now go do it in your own way. I don't trade the yen pairs. I don't trade those pairs. So they're not really affected, okay? Sometimes I might find my Aussie dollar really being affected at night, because Sydney session is affected during that time. You'd find that also Sydney session starts quite early when we are asleep, and ends also while we are waking up and about that. So do your own research. Come up with your own hypothesis, your own backtest data, and your own conclusion of the data. So when you're looking at London session, during this period, March, okay, and I'll talk about this later on, so just have it written, or you can do your own research, okay, March to November, okay, London session is always constant their time, okay, 8 a.m. to 4 p.m. But Kenyan time, the London session starts at 8 a.m. to, 10 a.m. to 6 p.m., okay. During this time, Nairobi is normally 2 hours ahead of London, so the 8 a.m. is our 10 a.m. and the 4 p.m. when the market closes is our 6 p.m. Okay, the 4 p.m. is our 6 p.m. So that's March to November. London, okay, session from November, okay, when they enter the winter, from November to March, their open is from 11 a.m. to 7 p.m. This is market sessions. Go read this when the night market shifts in terms of time. Do your own research. I'll talk about it in a different video. On the other hand, when you're looking at New York, okay, New York time, market opens their time, not our time. Their time is 9:30 a.m. Okay, that time during March to November is our time at 4:30, okay, because we're 7 hours ahead during that time, from 4:30 p.m. to around 12:30 a.m. okay, and the London session, and the New York session during November, New York during November to March, okay, since now we are 8 hours ahead, is our 5:30 p.m. to 1:30 a.m. Okay? Do your own research. That's homework. I can't give you everything. At the end of the day, will take a lot of hours. Put in that extra work, go and do some research, look at when the markets, not just the markets, but the whole world is just in general, when they have that change in timing during November to March and March to November. Go do your own research on that and figure out what normally happens and why we change. So that's sort of some homework I've given you. But it's important for you to notice those days they change, because it's going to be very important for us when we're going to be getting entries and when we want to get exits and when we want to watch markets. Like for me, I only pay attention to markets during those times. I do my pre-analysis early in the morning when I wake up. Then I'm very patient to wait for London session. I look at the markets during the first few hours of London session. No entry, I wait for New York session. During those first few hours, no entry, I wait till the next day. And that's simple. Simple. Trading should be simple, okay? So that's what I normally do, and that's the advice I wanted to share with you guys. So combine this previous video and this video that I've shared right now and try and put those candlesticks, patterns, entry sessions. Trading is like that. It's like putting puzzles together to look at the big picture and how I approach, how you should approach the markets in regards to how the markets work. Because like I said earlier on, markets are very random. You should have a system that is systematic, or a strategy that is very systematic, that helps you not be random like the markets. So that's it from me. Hope you enjoyed that video. And like I always say, stay woke, stay financially literate. May the peeps be with you.